Lady from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Mr. Chairman, and I thank you, Chair Powell, for your service. I want to associate myself with the comments of my colleague, Mr. Himes. I am concerned about banks' commercial real estate exposure, and I do hope that the Fed is doing everything it can to ensure that the exposure that these banks have will continue to be, in your words, manageable, because this is a looming crisis out there, given the workplace changes and dynamics. Chair Powell, in remarks on Bloomberg, Larry Summers, former Treasury Secretary during the Obama administration, stated that, and I quote, "It would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise than, quote, some of the more abstract and politically driven arguments that about various kinds of capital charges on the largest banks." Do you agree, sir, that it would be more productive for Fed supervisors and regulators to keep their eye on the ball, in this case, commercial real estate and other real estate investments?
I absolutely think we need to keep our eye on the ball on commercial real estate, and I think we're doing that.
I hope so. According to your semi-annual report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projections showed a median of, this is in the December FOMC, so this is now 3 months old, showed 3 rate cuts this year. So that would be 75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
So are you anticipating that there would be more cuts here coming?
It's not, the way I would say it is, we're making economic projections. And so we write down a path of growth, what's happening in the labor market, what happens with inflation, and what goes with those forecasts is an appropriate monetary policy, appropriate interest rates. So we expect inflation to come down, the economy to keep growing, the labor market to remain strong. And if that's the case, it will be appropriate for interest rates to come down, significantly over the coming years.
Good.
What will really happen, though, it's not a plan. What will happen is actually what the economy needs. The economy will do something different from that, and that's what will actually happen.
Chairman Powell, 15 members of Congress, including myself, Ranking Member Sherman, Chairman Barr, and Ranking Member Foster, sent a letter to the prudential regulators regarding the impact that Basel will have on U.S. capital markets activities. The letter highlighted critical areas of our U.S. markets, including securities underwriting, securitization, and derivatives that will be severely impacted by the Basel proposal. This was also a common theme represented throughout the comment file on the Basel proposal, over 95% of them. Considering that 75% of financing in the U.S. is done through our capital markets, which are the deepest and most liquid in the world, why would the Fed continue to pursue this flawed proposal instead of re-proposing a rule that would not have such a drastic impact on the U.S. economy?
Well, in fact, the capital markets concerns you raised are among those that I raised myself in our open board meeting when we put this out for comment.
You said you wanted broad support, and obviously there is dissent among some of your governors, the FDIC, others. So how are we coming on this, and how are we
we're working our way through the comments, and we're coming to the point where it'll be appropriate for us to begin to evaluate what changes are appropriate. I've said I think those changes will be broad and material, and that's where that is. But we haven't made any decisions yet. We just got the comments.
In my role as chairman of the Capital Markets Subcommittee, I have seen SEC Chair Gensler push the envelope in terms of rules and regulations that go well beyond the congressional mandate, even encroaching on the jurisdiction of other financial regulators. What is the Fed's response to another agency encroaching on its jurisdiction?
We do not comment on other agencies' regulation. However, if they were actually, to take your hypothetical at face value, if they were to come into our jurisdiction,
Oh, it's more than a hypothetical.
and we would react.
Good. Well, I hope you do. I yield back.